U.S. Treasury bonds are a cornerstone of the global financial system, serving as a safe haven for investors and a benchmark for global interest rates. Under Donald Trump's administration, various economic policies, including tax reforms, tariffs, and fiscal stimulus measures, have had a direct impact on U.S. Treasury bond yields. The yields on these bonds are influenced by factors such as inflation expectations, government spending, and investor sentiment, all of which were notably affected by Trump's policies. In this video, we explore the top 10 changes in U.S. Treasury bond yields under Trump's administration, providing insights into how these policies shaped the financial landscape. 1. Rising Treasury yields due to tax cuts. One of the most significant policy changes under President Trump was the Tax Cuts and Jobs Act, TCJA, which lowered corporate tax rates and provided tax relief to individuals. While the tax cuts aimed to stimulate economic growth, they also led to concerns about rising budget deficits and increased government borrowing. As a result, U.S. Treasury yields began to rise in anticipation of more government debt issuance. Investors, worried about the government's increased borrowing, demanded higher yields to compensate for the increased risk of holding Treasury bonds. 2. Increased volatility in the yield curve. Under Trump's presidency, the U.S. Treasury yield curve experienced increased volatility, particularly between short-term and long-term bonds. The administration's trade policies, such as tariffs and trade wars, generated uncertainty about future economic growth. This uncertainty contributed to fluctuations in the yield curve, with short-term yields rising more rapidly than long-term yields in some periods. The flattening of the yield curve during times of heightened uncertainty was a signal of potential economic slowdown, influencing investor behavior and bond yields. 3. Higher interest rates and bond yields from Fed rate hikes. Although the Federal Reserve operates independently from the White House, Trump's policies indirectly influenced the central bank's decisions. In response to the improving economy and rising inflation expectations during Trump's first years in office, the Federal Reserve raised interest rates multiple times. These rate hikes increased yields on short-term U.S. Treasury bonds, as investors adjusted to the new higher interest rate environment. The Fed's actions were in line with Trump's pro-growth economic agenda, which sought to boost investment and reduce unemployment. 4. Impact of trade wars on yield expectations. Trump's aggressive trade policies, particularly the trade war with China, introduced significant uncertainty into global markets. Investors typically viewed trade tensions as a potential drag on economic growth, which can lead to lower demand for bonds in the short term. However, during periods of escalating trade tensions, U.S. Treasury yields on longer-term bonds initially fell as investors sought safe haven assets. As concerns about global growth intensified, investors flocked to Treasuries, pushing down long-term yields, even as short-term yields remained elevated due to the Fed's rate hikes. 5. Fluctuations due to fiscal stimulus packages. The Trump administration implemented several fiscal stimulus measures, including the Coronavirus Aid, Relief, and Economic Security (CARES) Act in response to the COVID-19 pandemic. These stimulus packages increased government spending and, by extension, the supply of Treasury bonds in the market. The anticipation of higher deficits and debt issuance due to stimulus measures resulted in higher yields on U.S. Treasury bonds, as investors priced in the increased supply and potential inflationary pressures. 6. Expectations of increased government borrowing. Throughout Trump's presidency, government borrowing reached new heights, particularly as tax cuts and increased spending created larger budget deficits. As the U.S. government borrowed more money to finance its operations, Treasury yields rose in response to the growing supply of bonds. Investors required higher yields to absorb the increased debt issuance, reflecting concerns over the long-term sustainability of the government's fiscal position. 7. Changes in inflation expectations under Trump's policies. Trump's policies, particularly tax cuts and deregulation, were designed to spur economic growth, but they also raised concerns about inflation. The increased fiscal stimulus combined with a strong labor market led to rising inflation expectations. When investors expect inflation to increase, they demand higher yields on Treasury bonds as compensation for the decreased purchasing power of future interest payments. As inflation expectations rose under Trump's administration, Treasury yields followed suit, particularly in the long-term bond market. 8. Divergence between domestic and global bond yields. Under Trump, the U.S. experienced a divergence in bond yields compared to other major economies, particularly in Europe and Japan. While the U.S. Federal Reserve raised interest rates and allowed for a more aggressive fiscal policy, many central banks in Europe and Japan maintained extremely low or negative interest rates. This divergence made U.S. Treasury bonds more attractive to international investors, putting upward pressure on Treasury yields. The relative strength of U.S. bonds in comparison to global bonds was a key trend during Trump's administration. 9. Political uncertainty and its impact on yields. Political uncertainty, particularly around trade policies, tariffs, and the U.S. government's response to crises, had a significant impact on U.S. Treasury bond yields. The unpredictability surrounding Trump's trade wars and the potential for major shifts in fiscal policy caused fluctuations in bond yields. When uncertainty was high, particularly during periods of intense policy changes or government shutdowns, investors flocked to treasuries, pushing yields lower. Conversely, when the market anticipated favorable policy outcomes, yields rose. 10. Impact of COVID-19 stimulus and economic shutdowns. The COVID-19 pandemic presented an unprecedented economic challenge, and Trump's administration responded with massive fiscal stimulus, including direct payments to individuals and business loans. In the aftermath of the pandemic-induced shutdowns, U.S. Treasury bond yields initially dropped to historic lows as the Federal Reserve slashed interest rates and bond buying programs took effect. However, the eventual economic recovery, supported by vaccine distribution and fiscal stimulus, spurred a rebound in yields as investors anticipated higher inflation and stronger economic growth in the post-pandemic world. The policies implemented by the Trump administration had a profound effect on U.S. Treasury bond yields. From tax cuts and fiscal stimulus to trade wars and political uncertainty, these factors all played a role in shaping the trajectory of U.S. Treasury yields. In general, Trump's policies contributed to rising short-term yields due to fiscal stimulus and tax cuts, while long-term yields experienced more volatility as trade tensions and inflation expectations fluctuated. As investors navigated a complex economic environment, U.S. Treasury bonds remained a critical barometer for global financial markets. The interaction between Trump's economic policies and Treasury yields highlights the intricate relationship between fiscal decisions, investor behavior, and macroeconomic outcomes.